Okay, I had a lot of questions during the break. Apparently this is a topic of interest. I had questions and I wasn't able to give full answers to them because we haven't done enough yet on Bitcoin to have the answers be meaningful. So let's go through this now. We've peeled off some layers. We're going deeper so you can really see what goes on here. So I have a number of slides called How Bitcoin Works. This is the first slide. How a Bitcoin transaction works. So here's the scenario. And the scenario is that I have a microphone and an amplifier. And no matter how loud you talk, I can talk louder. Because I'm only at 84%. And I can keep on moving the microphone level up to the point where I can deafen you. I can always talk louder than you can. Don't make me have to do that. Okay? It's going to hurt your ears. All right. So Bob, an online merchant, decides to begin accepting Bitcoins as payment. Alice, a buyer, has Bitcoin. Now you know what that means. She doesn't actually have Bitcoin. Her address is credited with owning a certain amount of Bitcoin. That's what it means for Alice to have Bitcoin. And she wants to purchase merchandise from Bob using those Bitcoin, some number of them. Now, Bob and Alice both have to have Bitcoin wallets. Otherwise, there's no effective way for this transfer to occur. The wallets can be on their desktop, it can be on their cell phone, doesn't matter. But the wallet consists of software that is able to transmit transaction records into the Bitcoin network. The wallet includes some public domain, some public source code, and also might have some proprietary code for the user interface or something like that. But there are many Bitcoin wallets out there that you can install on your phone. Wallets are files, this is accurate. Wallets are files that provide access to multiple Bitcoin addresses. So what's in your wallet is your different Bitcoin addresses. You can have as many as you want to preserve anonymity so that when people that you buy things from get together, they can't trace those transactions as being associated with the same person because the address is not associated with a name. Okay? Now, the wallet contains information that allows you to do these transfers. Now, every one of these addresses has a private key associated with it. Otherwise, you cannot digitally sign the transaction record. Your wallet maintains the private key associated with each address. So when you want to transfer money, you can pick which address you want to take it out of. And of course, your wallet will also tell you on the screen how much Bitcoin is associated with each one of the addresses. So you can pick which one you want to use for this transaction. An address is a string of letters and numbers, such as, you look on your printout there, it's this meaningless string of letters and numbers. This actually happens to be a public key in something called an elliptic curve crypto system. Remember I told you that any one-way trapdoor function can be used to generate a public-private key pair in a public key crypto system. Well, there's one very, very good one-way trapdoor function, and it happens to be associated with mathematical objects called elliptic curves. The benefit of using elliptic key cryptography is a 40-character key in elliptic curve is equivalent to a many thousand-bit key in RSA. And so you can use relatively short keys that have the same protective power as extremely long RSA keys. Okay. Now, that's what an address is. It's the public key corresponding to a private key, which you don't tell anybody. Your wallet knows the private key. The world knows your public key because that's how you're going to receive the money. So when Alice wants to pay Bob, Bob tells her what address he wants the money sent to. It's not sent. It's essentially associated with that address. Okay? Now, Bob can create a new Bitcoin address if he wants to. He just pushes a button on his app and it says, create new address. And it'll create a new one and it'll add it into his wallet. He doesn't have to. If he's a well-established merchant and he's not doesn't care about anonymity, he can just use one address if he wants to and ask everybody to pay into that address. But he doesn't have to. he can create a new address, and that address will be sent by his app to Alice's app, so that Alice's app will know how to create the transaction record to transfer the Bitcoin to him. Okay? Now, number 2, how Bitcoin works too. Submitting a payment. Alice tells her Bitcoin client that she'd like to transfer the purchase amount to Bob's address. So Bob says, this transaction is going to cost you 0.00001 Bitcoin. Bitcoins can be denominated down to 1/100 millionth of a Bitcoin. The smallest unit is called a Satoshi, in honor of this anonymous Satoshi Nakamoto person. So 100 millionth of a Bitcoin is called a Satoshi. So Bob is going to tell her how many Satoshis she has to transfer. And her client then is going to create a transaction record and digitally sign it with the private key corresponding to that particular, the address from which she wants the Bitcoin to leave. Okay? So Alice's wallet holds the private key for each of her addresses. The Bitcoin client signs her transaction request with the private key of the address she's transferring Bitcoin from. So she might have 10 addresses. She's going to pick one to transfer the Bitcoin from, and her wallet knows the private key so it can create and sign this transaction record. Now, anybody on the network can now use her public key, which is her address. They can use her address to verify the transaction request actually came from Alice. No, it didn't come from Alice. It came from somebody who knew the private key that corresponds to that address. No names here. As you can see on the previous slide, this address doesn't contain any name. And furthermore, there's no record in any place that says it's Alice Doe that owns that address. There's no registry of addresses. It's just a key. Right? So anybody on the network can now verify that the transaction is legitimate because the address from which the money is coming, the transaction record was correctly signed with the private key corresponding to that address. So any of the 11,000 people in the network can immediately verify that the transaction record is accurate. Okay? Now, here's where the miners come into play. This transaction is broadcast by the client, the client running on your cell phone. It is transmitted to another node, one of these 11,000 nodes, which then transmits it to its neighbors, and it distributedly circulates through the entire 11,000 nodes. As soon as miners see it, and not all the 11,000 nodes are miners. All the 11,000 nodes maintain the blockchain, but they're not all miners, because miners have to have big computation centers in order to do what I'm about to show you. What the miners do is they accumulate the transactions of the past 10 minutes after verifying that they really came from the right address and that they're digitally signed properly. And furthermore, that they search the blockchain to make sure that there's enough money associated with that address to satisfy the transfer. Then they accumulate those transactions into what's called a block. And that block is not just Alice and Bob's transaction, it's all the transactions around the world that occurred during that period. They're accumulated by the miners into a block. The miners' computers are set up to do hash calculations. And I'll show you in a second what the hash calculation looks like. Okay? Well, I can tell you right now. Basically what happens is there's a block of data. And the computation that the miner does is he creates a nonce. Puts a nonce in here. Just generates a random number. Puts a nonce, adds a nonce to the block, and then hashes the block. So H of block concatenated with nonce. Let's say nonce I. Okay? If that hash is less than a certain number, then he wins. He has succeeded in verifying the block, and he's going to get paid 12.5 Bitcoin, which as of today are worth 125,000 US dollars. That's a lot of money to get paid for some hash function calculations. However, what's the probability that if you put a random number in there, that the hash of that is going to be less than that? Well, it's real small. That's the probability. And so as the number of zeros increases here, the number of tries that you would have to stick in here, because if this fails on nonce I, then he has to try nonce I plus 1. He has to make up another random number, and he keeps going until the hash value is small enough. And it takes a lot of computation to do that. And there are a lot of guys around the world simultaneously doing it because each of them wants the 125,000 US dollars. And somebody wins first. And the guy who finds a value that causes this hash to be less than that number is the winner. Now, as soon as he does that, he puts, well, actually before he does it, he puts a transaction in that says he makes up an address and 12.5 BTC go to that address. That gets stuck in the block. Okay? That's how he pays himself. All right? Now, all the other guys in the world who are the miners, as soon as they see that he's won, they stop their computations because it's not going to do them any good anymore. And anybody in the world can now verify the accuracy of this block, because all you have to do to check that the miner did his work is you just have to hash this and see if it's less than that. And so all the 11,000 nodes in the network can immediately verify that the miner did his job. And once the miner does his job and it's verified by the network, it gets added into the blockchain. This becomes the latest block in the blockchain. And now, as soon as all the other miners hear that this happened, they stop their work and they start waiting for the next block to occur so they can try again on the next block. Obviously, you can see that the guy who has the most computational power is more likely to win than anybody else. And so guys are spending more and more and more money on doing distributed parallel computations in an effort to be the miner of blockchain blocks, because if you won every time, so what's 6 times 125,000? Is 750,000, something like that? You can make 750,000 US an hour if you were the successful miner of every block. This is a lot of money. All right, let's keep going here. Okay, so here is what happens. There's a hash value in here that comes from the previous block. There's the transactions in this block plus this nonce, which is the new hash value that successfully resulted in a value less than a certain amount. And that's determined by the code in the network. And this varies. This is called the difficulty. And it's adjusted over time so that the average amount of time necessary for a block to be verified is 10 minutes. That's what it's designed to do. Okay. So you can see that we have this blockchain. We have this block. This whole thing hashes, and it becomes the hash value in the next block, plus this whole thing hashed becomes the hash value in this block. And you have to always add the nonce in. And any of these blocks you can verify. You can hash that block yourself and see if the value is less than that. You can hash that block. You can hash that block. You can verify the integrity of the blockchain. Now, suppose somebody wants to modify this blockchain by changing the record so that this, instead of showing a transfer to that person, it shows a transfer to somebody else, like to him. Or he wants to steal some Bitcoin. Well, that can't work because he's then going to have to go through this whole hash function calculation to find a correct nonce that results in a hash value less than that number. Then he's also going to have to do the same thing here, because once that changes, now this won't hash properly anymore to that. You have to do that calculation all over again. You have to do that all over again. And there's not enough time in the world to do all that. So that's why these records have become unforgeable. Because in order to create a valid sequence of blocks, you have to do much too much computation to do that. And if you did, you'd be the only one in the world who did it. What about all those blocks out there in the other 11,000 nodes? Now all of a sudden it wouldn't agree. So not only do you have to do it, you have to get more than half the network to do it and agree with you. And it's not feasible to do that unless the miners together, if they all get together, they could do it. Especially if miners become, if more than half the miners are controlled by some central authority. But that hasn't happened yet, although there's some risk of it happening. Okay? Now, we have the new block is added to the blockchain. The miners don't have any way to predict which nonce is going to produce the hash value with the correct number of leading zeros, so they're forced to try a huge number. And actually, the number that get tried by all the miners in the world every 10 minutes is measured in quadrillions. Quadrillions of hash function calculations are done. Most of them are wasted because only the one that the successful miner finds goes into the blockchain. Each block includes a coin-based transaction. This is the way the miner gets paid. It pays out, when this slide was made, it was 50 Bitcoin. Every some number of years, it goes down by half. So it went from 50 to 25, now 12 and a half. It's going to be 6 3/4 eventually, 6 1/4 eventually, et cetera. Now, the transaction has been verified. As time goes on, Alice's transfer to Bob gets buried beneath other more recent transactions. So there's the block in which Bob transferred money to Alice. But then there's another block and another block and another block. And maybe Bob didn't transfer any more money since then. How do we find out how much Bob has associated with that address? We got to search the blockchain. And there are websites which will let you can get code that'll search the blockchain. There are websites that'll search the blockchain for you. Okay? So your Bitcoin client software, when you ask it to generate a new address, what it does is it generates a public-private key pair in an elliptic curved public key crypto system. A 44-character key is as strong as a 7,000-bit RSA key. I don't know anybody who uses 7,000-bit keys. When we looked at the digital certificates in Lecture 4, I showed you what some RSA keys look like. They were 2,048 bits. This is as strong as a 7,000-bit key. So to send Bitcoin, the user specifies a receiving address and an amount and clicks send. That's all there is to that. It's sort of like PayPal. All I had to do was give an email address and an amount, and it got transferred, right? To receive Bitcoin, you just tell the sender what your address is that you want the Bitcoin associated with. Addresses are not registered to users. There's nobody who knows the connection between your identity and your Bitcoin address unless you choose to tell them. Now, let's look at Bitcoin Info. Bitcoin.info is one of these websites that will allow you to search the blockchain. Here we go. Oh, very interesting. This is looking at the price of Bitcoin in different currencies. Right now, literally right now, it's $9,813 US and 5 cents. Let's see if we can find HKD down here. Here we go. 76,930.58 Hong Kong dollars. All right. Now, if we look at what happened here, prices and data, I want to look for what happened to the, very strange. When I did this a little while ago, now this is comparing the current market cap of Bitcoin to other currencies, other digital currencies. But this enabled me to search the blockchain, so hang on a second. Bitcoin Blockchain Explorer. There we go. Okay, latest blocks. Notice, so the height is the block number. We think of a blockchain as being horizontal. Blockchain thinks of it as being vertical. So the height is how many blocks there have been since the first block on the bottom. Okay? So we just finished the 512,582nd block. And that was 24 minutes ago. And there were 869 transactions in it, accounting for 2,511 Bitcoin. Well, a Bitcoin is around 10,000 US dollars. So 2,500 of them is a lot of money that was transferred in the last 10 minutes. The size of the block in kilobytes was about a megabyte long. And let's look at the transactions. Very interesting. You can search an address. A block height. How about this? Let's enter a block height of 512.582. There we go. There are the transactions in the block. You can see them. They're right there. Okay? This was a newly generated coin. This one is a transfer from this address to that address of 0.1 Bitcoin. This one's a transfer from this address, which looks like it is the same as that, to a different address. So this person sent 0.1 Bitcoin. We don't know who that is, but whoever it is sent 0.1 Bitcoin to this address and 2 Bitcoin to that address. Now this is a different guy, and that's for a smaller number of Bitcoin. And this one is 0.008 Bitcoin, which is 84 US dollars. See, when you mouse over it, it tells you the value. Really cute. Now, this is the public ledger. Every transaction there has ever been, you can search all the way back to the beginning through the 512,000 blocks. It's no problem because 11,000 nodes in the world, a node is a computer. 11,000 nodes in the world have the entire blockchain. And what's amazing about this is it's all public, but it's completely anonymous because you have no idea who that is. But if you want to find out how many Bitcoin that address has, it's very easy. You have to do a search over the blockchain, but it will come up with an unambiguous answer for you of how much Bitcoin this guy has. And this guy might be the same as that guy. He just might have 2 different Bitcoin addresses. You don't know. There's no way to tell that. Well, not exactly no way to tell that. And there is a failure of anonymity in Bitcoin, not because of the protocol, but because of the necessary way in which these things are implemented. How does the transaction get into the network? It gets into the network by being transmitted over the internet from your Bitcoin client. Well, but that's in packets, right? And the packets have a sending address and a destination address of your IP address. And so if I send 2 different transactions using different addresses, okay, different sending addresses, these are not IP addresses. These are Bitcoin addresses. These 2 would have the same IP address associated with them when they get into the first node in the network. After that, they don't anymore because that node sends the transaction somewhere else, and my IP address vanishes then. But the first guy that I send my transaction to knows my IP address. So there have been studies, actually at CMU. They studied how relatively easy is it to determine somebody's identity from these transactions. And it turns out it's not nearly anonymous as you think. But if you're very careful and you never send the transaction to the same guy, the first guy in the network you send it to always is different, then the chance of being able to correlate your IP address is much, much lower. Then the people you send it to would have to all get together and share information. And that's somewhat unlikely. Anyway, it's astounding. Your bank doesn't make your account records public. Why? Because they're associated with a known person. The reason you can make this public is it's at least ostensibly anonymous. It's really cute. I mean, you should explore these different blockchain websites because they contain some fascinating information. All right, now back here. Bitcoin mining. Bitcoin chains begin with data mined by performing a large number of hashes. A miner tries many different, for example, 10 to the 15th may have to be tried in order to find one that hashes down to the right value. Success is rewarded with Bitcoin. The threshold declines over time. Threshold meaning how many Bitcoin you get as the reward. It's now 12.5. It's going to go down to 6.25 on June 20th, 2020. And that's built into the code. You can go look at the code and see when it's going to go down again. Bitcoin hashes are progressively more difficult to find. The reason for that is the difficulty keeps increasing. It keeps increasing because miners are pouring more and more computational power into mining because it's so valuable. And so to keep this at a 10-minute pace, they have to make the difficulty increase. Otherwise, the miners will finish their jobs too fast. There will probably never be more than 21 million Bitcoin. The reason is that it's built into the code that the rate at which they can be generated declines over time and asymptotically approaches 21 million. Now, you heard in the video, there will never be more than a certain number of Bitcoin. That's not literally true. The reason it's not literally true is these guys in the network are running open source code. If all the guys in the network get together and agree to change some of the parameters in the code, then you can generate 42 million Bitcoin or 1 billion Bitcoin or however many you want. Now, it's not so easy to get them to agree, but they have actually agreed on some technological changes to Bitcoin. So don't go around thinking there'll really never be more than 21 million. There could be. All right. This was, as long as you obey the code, this shows the total number of Bitcoin in circulation over time in millions. Now, how do you control that? Well, the way you control that is how do Bitcoin get generated? It's only through mining. And so if you make mining more and more and more difficult and you reduce the reward for mining over and over and over again, eventually there won't be any reward. If there's no reward, there's no new Bitcoin. So you might say, why would somebody be a miner like after 2033 when there are no more Bitcoin available to be mined? Why would somebody ever be a miner? The answer is at that time it's believed that people will actually pay a fee to have transactions verified. But it won't be in new Bitcoin, it'll be in Bitcoin you already own. And so it won't change the total number of Bitcoin in existence. All right, Bitcoin value. All right, first I'm going to go from September 2013 to January 2017. Then we'll do more recent, because it won't fit on this chart, because this only goes up to 1,200, and it's near 10,000 now. What's amazing is the massive fluctuation in Bitcoin. So I started teaching here about Bitcoin, I don't know, 6 or 7 years ago. The first year was worth $2. Next year worth $5 US, et cetera. And then all of a sudden, in 2013, it massively spiked, getting up to a peak of 1,238 US on December 4th. And then there were massive fluctuations as various things happened in the world. When Zynga decided to accept Bitcoin, it went up. When Alibaba banned Bitcoin, it went down. Then Mt. Gox, which was this exchange in Japan. And people are wondering, okay, if this is all so secure, how can people steal Bitcoin? Yeah. They can't steal Bitcoin from your wallet. But they can steal Bitcoin if they hack an exchange. Because what's an exchange? An exchange is somebody who's holding the ability to put Bitcoin in and out of your address. Because when you want to buy Bitcoin for cash, who are you going to pay? Well, let's suppose I want to buy some of your Bitcoin for cash. I suppose if I'm physically in your presence, I can hand you the cash and I can watch you enter the transaction into the network. But suppose we're not face-to-face. Suppose you don't even want to be known who you are. That's what exchanges are for. You go to the exchange and you say, please buy me 5 Bitcoin. And I will wire you the money from my bank account. Fine. Where is the software that's going to know the keys necessary to do the transfer? It's going to be at the exchange. Because at any moment you may say to them, you know what? I'm worried. Bitcoin's going to go down. Please sell my Bitcoin and transfer the value back into my bank account. they have to have the ability to transfer your Bitcoin, which means they have to have the private key associated with your address. All right. Now a hacker breaks in. Maybe the hacker doesn't even learn the key. All he has to do is get access to the software that transfers Bitcoin out of your account or out of your address. If he can do that, the money's gone. If you interrogate the network and ask how much you have, it might be zero now, because he might have transferred it all to some other address. That's how hackers steal Bitcoin. They don't mess with the network. The network is secure. It's distributed. You can't mess with every node in the network. What you do is you mess with an exchange. And so Mt. Gox was such an exchange in Japan. They announced a theft of $400 million US in Bitcoin, and the Bitcoin dropped precipitously in value. So there were all these world events that occurred with respect to Bitcoin. When the mining reward went down, the value of Bitcoin went down. There was another, this is a small theft, 65 million, and it caused it to go down. Then it peaked again. Okay, so this is its value from February 2017 to February 2018. Of course, this is inaccurate now because it's March 2018. But you can see it peaked at US $19,783 on December 17th, 2017. And it's fluctuated wildly since then. It went down to around a little over 6,000. I think there was a little dip below 6,000 on February 6th, 2018. And if you're interested in what's going on currently, I think I have that in Bitcoin charts here. So Bitcoin Charts is a website that you can go to. It's called bitcoincharts.com. And you can get charts for any time period to what the value of Bitcoin was. So when I started teaching about it, it's very tiny. And then it stays low. And then all of a sudden, it gets wacky. And March 8th, 2018, closing price $10,034. But, of course, that's as of a certain time. And you saw earlier when we went to blockchain.info that it's gone down. It's about 9,600 US dollars. So it fluctuates wildly during the day. But if you go up here and you ask, for example, for the time period, it says all data, you can have how has it varied in the past day. There's how it varied. That's a lot of variation in one day. It went from the high above 10,100 to a low of 9,550 intraday. This is in less than a 12-hour period. So it's going crazy. Okay. Let's go back to. Oh, I wasn't there. Okay. I just see that message that CMU got a new president. That'll be interesting for me to look at later. Our president of our university, was hired 5 years ago after a worldwide search. He was fantastic. He was formerly dean of engineering at MIT, brilliant scientist. He was originally a material scientist. He became a computer scientist and a biologist. And when he gave a lecture, I mean, I was awestruck by the intellect of this guy. However, and after being the dean of engineering at MIT, he became the head of the National Science Foundation of the United States. So he was the one who gave out all the research money for science in the United States. So CMU hired him as president. But there were problems. He was somewhat imperious. He believed himself to be president for life, for example. And he believed himself having the power to inject himself into every decision made in the university. And the deans got together, like the Roman Senate, which stabbed Caesar. The deans of the different colleges at CMU got together, and they stuck the knife. And our policy at CMU is if you have a term appointment and you're not going to be reappointed, they tell you a year in advance so you can rearrange your life. So the president had a 5-year contract. At the end of the 4th year, they said, you're not being renewed at the end of 5. And he said, "The hell with you, I'm out of here." He didn't stay. And now he's the president of a university in Singapore. But it was very strange, because the normal thing that you do when you have a contract like that is you finish out your term. And so it left the university suddenly without a president. And so apparently that email notice that you just saw, that was from the chairman of the board of trustees of CMU announcing their decision for who the new president's going to be. And the question is whether it's going to be the interim president, whom I love because he's a computer scientist, or whether they found somebody else. I don't know. But I'm not going to look now, because I'm in the middle of teaching. OK. So here's an example of a Bitcoin wallet you can get. You can download the Electrum Bitcoin wallet. And what it shows you is a whole bunch of transactions, amounts, what your balance is. Now, this is a notional idea of what your balance is. It's based on what the blockchain says. It's not like a bank account where you take money out and put money in, and the bank maintains the ledger. This is not the official ledger. What this is a reading of the blockchain to determine how much money you have. Okay? So this is accurate because it reflects what the network actually says you have. And so to engage in a transaction, it's really simple. You key in an amount, and you enter a Bitcoin address, and you say send, and it's done. OK, now let's look at what the blocks look like. So here is a transaction. Owner 0 wants to transfer, let's say it's 1 Bitcoin. He wants to transfer a Bitcoin from himself to owner 1, a 0 to 1 transaction. All right? Now this transaction record involves owner number 1's public key, that's his address to which the transfer is going. These two things, whatever came before, is input along with this to a hash function. This whole thing is then encrypted with the private key of number 1, and that becomes, of owner 0. That becomes owner 0's digital signature, right? You take a transaction record, and you hash it, and you encrypt the hash with your private key. That's your digital signature. Okay? Now, here's a situation where owner 1 wants to transfer something to owner 2. It's exactly the same thing. Owner 2 wants to transfer to owner 3, et cetera. But these are transaction records. These are not the blocks. These are transaction records. Let's look at the blocks. Okay? Problem here is that this owner 0 might inject multiple transaction records, transferring all of the money in his account, or in his address, to multiple people. That's double spending. So other payment schemes like banks use a centralized trusted intermediary, or a database, to verify that a coin hasn't been double spent. Bitcoin relies on the public peer-to-peer network. The details of each transaction are broadcast to the network. Every node becomes aware of every transaction. If Bitcoin is involved in multiple transactions, if there's double spending, or you spend more than you have in your address, the network will detect that, and that transaction will not be added to the block. So you cannot transfer money that you don't have to somebody else, because it will never get into the block and will never be verified. All right. So here's what the blockchain is. So only the first transaction counts, because there's a timestamp on all of these things. So if there are multiple transactions, one of which got you down to 0, and the next one of which got you below 0, which one wins? It's the one that's earlier in time. It's the same thing as the land registry. The first deed wins. Okay. A transaction history is a chain of transactions leading from the original generation of the Bitcoin, from when it was mined. Okay? Histories must be easy to verify. They are easy to verify because all you have to do is hash something and see if it hashes to the correct value. You don't have to have a huge computer center to do that. If transaction histories are difficult to generate, then they can't be faked. So here's a situation. Here's a block in which a Bitcoin was created. All right? Now, here are transactions involving this Bitcoin. Here's one transaction. Here's another transaction. This as input to a hash function. That's input to a hash function. That's input to a hash function along with the next transaction, etc. The problem with this chain of transactions is anybody can generate this. Because in order to generate it, all you have to do is do a hash function. Anybody can do a hash function. So this is not a secure blockchain. Because if somebody wanted to forge this, he could change this transaction, make it look like the Bitcoin went to somebody different, and then it would be easy, because this becomes input. All you have to do is take this and hash them. Anybody can do that. And he could also change this. He could change this record and then hash them. So it would look legitimate. So this doesn't work. You can't do that. That's why you need these nonces to make it very difficult to create the correct hash function. So what happens here is, to make it difficult, you add a requirement of a nonce which causes a hash value to be within a certain range. So now, here's a hash of the block that created the Bitcoin. This previous hash becomes part of the new block. All these transactions become part of the new block, and the nonce becomes part of the new block. And the value of this block, when hashed, has to be less than some number. Anybody can verify that. Now, the hash of this becomes input to the next block. These are the next transactions that occur in the next 10-minute period. And then a new nonce has to be created to cause this block, when hashed, to hash to less than that value. Now, let's suppose I want to change something. I want to forge that transaction record so it looks like it comes to me instead of to the real recipient. I can do that. But when I change one bit of this, the hash of the whole block's going to change. So I'm going to have to find a new nonce that makes this block hash to less than that number. Well, that's going to take me 10 to the 15th calculations to do that. And the problem is I better do it with the most recent block, because if I do it with a block back here, I'm going to have to change every block into the infinite future, because none of these hashes are going to now have the right value. This previous hash will not match that. If I change the hash of that, it won't match. So I have to do a massive amount of calculation in order to try to alter the blockchain. That's why it's regarded as secure. All right. So each mining node tries to generate a new block with new transactions. Node accepts the block by creating a new one, for which it earns 25 Bitcoin, cut in half every 4 years, now down to 12.5, and broadcasts the new block to the network. The other nodes verify the hashes. That's very fast. All you have to do is hash something. You don't have to find nonces. So all the nodes verify the hashes, check for double spending, that is to make sure that there isn't any transaction in there that came from an address that didn't have enough money. Why? The miner might have lied. The miner might not have done the verification. He might have put it in there anyway. And to check to make sure that he was honest, everybody can verify not just the block, but verify that all the transactions are coming from addresses that have enough money for that transaction. So nobody can overdraw in Bitcoin. A forger or double spender, in this case double spender means somebody spending money he doesn't have, cannot fake the whole chain. It's computationally infeasible to do that, provided that mining takes a lot of work. All right. So let's look at this drawing. Alice wants to send Bob 2 Bitcoin. And this is my usual thing, right? We're going to go through it again with a different graphic. Alice wants to send Bob 2 Bitcoin. She sends a transaction request to the blockchain. How does she do that? From her wallet. Her wallet, she enters Bob's address and the number 2 for 2 Bitcoin, and her wallet will create a transaction record and broadcast it to the network. It doesn't broadcast it to the whole network. It broadcasts it to a small number of nodes in the network, and they take over from there and send it on. Okay, so this is a request to send Bob 2 Bitcoin. Okay? Then computers known as miners verify the transaction. They're supposed to check Alice's balance to make sure she has 2 Bitcoin. But suppose the miner lies, or the miner doesn't do that. Later on, other people are going to check him. Okay? But if he wants to earn his money, he'll do it right. And he competes with other miners to put this in a block with other transactions. Now, the blocks are all going to be different that the miners are mining, right? If I want to mine a block, I have to put a transaction in there that pays me 12.5 Bitcoin. If you want to do mining, you have to put a transaction in there that pays you 12.5 Bitcoin. So all the miners are working on different blocks. And whoever gets the hash value, a nonce, that produces the correct hash value is the winner. And so that's the guy that gets to append his block to the prior blockchain. All this computational work protects the blockchain against hackers. Then, after it's done, others in the network check what the miner did. They make sure, for example, that Alice really did have 2 Bitcoin before it was transferred. You don't have to trust the miner. Nobody has to trust anybody in Bitcoin. Once the answer is verified, when a majority of miners in the network approve the block, then the miner who solved the puzzle gets paid. And the way he gets paid is that block gets added to the blockchain. And so if right after that, if you ask, how many Bitcoin does he have? It's 12.5 more than he had before. Okay? Alice's transaction, of course, is also going to get added to the blockchain because her transaction is part of that block. The miner's transaction, Alice's transaction, and all the other transactions. We saw, what do we see? There were 800 and some transactions in that most recent block. Okay. And then Bob, it says Bob receives 2 Bitcoin, but he doesn't receive anything. What's happened is 2 more Bitcoin have been associated with his address. He doesn't receive anything. He does receive a verification of the transaction.
How do we determine which miner actually finished the hash first?
He says, "Here I am."
I know, but do they actually depend on the server timestamp or?
No, it's not. No. Oh, you mean as in case 2 miners?
Yes.
In case 2 miners finish nearly the same time, and each one says I'm the winner? Yeah, it's timestamp.
Because I also noticed it's when the distribute database system,
Yeah.
right, across globe, and then they use a very sophisticated device like atomic clock to make sure the time calibration.
Yep, it's always a problem in a distributed network. I mean, this goes back to Einstein, right? As to there's no such thing as universal time.
So how do
Yeah.
they do that?
Because you have to have clocks, and the clocks have to be synchronized. When you announce a transaction, you apply a timestamp to it, and if you lie, then the person who receives it will know that the timestamp is false. By the way, I have a recommendation for you. If you want much more detail than most people can stomach, then let me show you a book that you can go to. Okay, this is free on the web. It's the early O'Reilly edition of Mastering Bitcoin. You can download the PDF. It's 282 pages long, and it contains an unbelievable level of detail as to exactly how everything in Bitcoin is done. And when I say unbelievable detail, it gets down to stuff like this. Okay? I mean, it's really a tremendous amount of detail. It shows you what the blocks look like, what the transaction records look like. Everything is in there. All right. Continuing on. Why you can't cheat at Bitcoin? You know this already. The reason you can't cheat at Bitcoin is you don't have the ability to do all the necessary hash function calculations to find the nonce that's required to make the block look valid. Okay? Especially if you're trying to alter anything other than the most recent block. It's really impossible. Okay. It's desirable for the number of Bitcoin to grow, but the rate of growth has to slow down, otherwise we'll have uncontrolled inflation, and Bitcoin eventually won't be worth anything. The computations automatically get harder and harder, which slows down the growth rate. And I say it's vaguely similar to Micromint. Remember, in Micromint, in order to create a coin, you had to find hash function collisions. And that was very difficult. That's why you couldn't forge them. Here, you're not finding hash function collisions. You're finding a nonce value that creates a certain hash value. Not one hash value, but it has to be in a small range of hash values. You'd never succeed if you had to find the exact hash value. Okay? It now takes about 10 to the 17th hash computations in order to do this. The Bitcoin network collectively, all the miners working together, are doing about 10 to the 19th hashes per second. And you multiply that by 10 minutes, and that's a huge number of hash function calculations going on. Here's a picture of some actual equipment. These are application-specific integrated circuits. These are specific circuits. They're created to do the hash function calculations, which, by the way, is SHA-256, is the hash function used in Bitcoin. So these are SHA-256 boards that do this. You can do 10 billion hashes a second with this one. It costs you 15,000 US to buy it. Yeah, but you know, if you successfully get 12.5 Bitcoin, it's 125,000 US, right? You multiply your money by 8, you know, immediately. All right, here's a Bitcoin mine. This, I believe, is actually in Hong Kong, and the bill is 1 million Hong Kong a day just for electricity. So this is not for kids. Okay, this is you need some serious bucks to do this. There's one Bitcoin group, it is believed, that now controls 51% of the total mining power, not 50% of the 11,000 nodes, but 51% of the mining nodes. That's a problem, because who knows what they might do if they get together. All right. So here's some features of Bitcoin. Remember, coins don't exist. There's no such thing as a Bitcoin. You can own one, but you can't hold one, and you can't send one, and you can't look at one. There's no, if you look through that entire Bitcoin book, the 282 pages, which show you what the transaction records look like and what the blockchain looks like, they will never show you what a Bitcoin looks like, because there's no such thing as a Bitcoin. I mean, you have to really accept this. There's no such thing. There's no centralized control. Everything is done by Bitcoin clients running open source code. There's no Bitcoin Limited. That is, there's no company that's sitting behind this, you know, earning a lot of money and controlling it. Same thing is true of gold, right? There's no Gold Limited. There's no company that controls all the world's gold. That's why gold is popular in times of financial crisis, because it's always negotiable. Okay? It's largely, but as I explained, not fully anonymous. There's no government supervision of the network. There can be supervision of individual nodes and individual users. I mean, the US government can compel me to transfer my Bitcoin to you if they want me to. But they can't compel the network to do anything, because the United States government and no government controls the Bitcoin network. However, there's no recourse if the system fails or becomes corrupted. No recourse. You can't go to the government and say, I want my money out of the network, because the government doesn't control the network. But it is a real functioning virtual currency system. And you have to decide whether you think there's any real value associated with the Bitcoin. Somebody asked me this earlier, and if I own any virtual currency, and I don't, because I'm convinced by my own aphorism here, which is that a Bitcoin is a chain of title to nothing. And I don't want chains of title to nothing. I want chains of title to something. Yes, it's going up in value, but it doesn't always go up. It sometimes goes down. And if I could predict when it was going to go up and buy it before then, I wouldn't have to teach for a living. Okay, I could do other things. Bitcoin anonymity. Laundries exist for washing Bitcoin. This is amazing. What you can do is, if you're worried that your address somehow has been compromised, then what you can do is send your money to a Bitcoin laundry, and what they will do is they will collect a lot of Bitcoin from a lot of folks, and they will send you back laundered Bitcoin. I mean, the mafia does the same thing, right? They have guys who launder casino money for them so they can hide it from the government. It's the same thing. Bitcoin in Hong Kong. HKMA says it won't regulate Bitcoin. Why? Because they regard Bitcoin as a commodity. It's like pork bellies. It's not like money. And so they don't have the authority to regulate the trade in pork bellies. Possibly some securities organization does, like in the United States. There are commodity trading regulators. But in Hong Kong, it's not regarded as money. This created speculation that Hong Kong would become a hotbed of Bitcoin activity because it was X-regulation. You'd be able to do stuff and the authorities couldn't come down on you. I don't know that that ended up really being true. Investors fear $3 billion loss in closure of Bitcoin trading company. This is another thing where the Bitcoin trading company all of a sudden says, well, we're bankrupt. We can't continue operations anymore. Well, if they can't continue operations, how are they going to transfer your Bitcoin out? It's awful. I mean, but this is not a failure of Bitcoin. This is a failure of exchanges that trade in Bitcoin. Bitfinex, I showed you that one. That occurred in 2016, 72 million, 120,000 Bitcoin at the time. Now 120,000 Bitcoin would be serious coin. It wasn't then. All right. There isn't much regulation. In different countries, they have different attitudes toward it. In Russia, the Central Bank of Russia regards it as a dubious activity. I don't think that stops the oligarchs from trading in it, but the central bank says it doesn't, it wants to keep hands off. The United States Financial Crimes Enforcement Network, the attributes of Bitcoin attractive to lawful users also happens to attract illicit actors. FinCEN is observing a rise in the number of suspicious activity reports flagging virtual currencies as a component of suspicious activity. Suspicious activity is drug-related, crime-related, money laundering, etc. As very often Bitcoin appears to be used for that purpose. Some people predict a Bitcoin will eventually be worth $1 million. Some people say it will decline to 1 cent. I think 1 cent is more likely than $1 million, but I don't know. Use in crime is endemic to all anonymous virtual currencies. It's all endemic to all anonymous currencies. Cash. Cash is used in crime because it's untraceable. Bitcoin is used in crime because it's essentially untraceable. Is anonymity critical? Regulation seems inevitable. It was reported earlier that there are a couple of countries that are considering issuing their own virtual currency, in which case it would be regulated. And it would lose all of the anonymous features of Bitcoin. Anytime you have a mechanism that promotes crime, eventually the authorities find a way of regulating. They're thinking about it with Bitcoin, but they haven't hit on the answer yet, because it's so cleverly arranged that there's no way that a regulator can regulate the network. They might pass laws that say you, a resident of Hong Kong, cannot do X, Y, Z. If they find you, then you get criminal penalties. But they can't actually physically stop you from doing it. Now, Bitcoin versus blockchain. I told you there are 1,500 virtual currencies. Bitcoin has competitors. And you can see that the next closest competitor, Ethereum, has a market cap of 50% of Bitcoin and growing. And nothing stops you. If you want to set up your own virtual currency, go publish your open source public domain code and go for it. And if people buy it, and you've started out with a lot of it, you're going to get rich. And so eventually, I mean, Bitcoin is no longer, even though it's the largest, it does not control the virtual currency world. And so if there are better systems that show up, people will take their money out of Bitcoin, put it in the other one, and the value of Bitcoin will decline. So when bankers started looking at this, they realized that Bitcoin itself is but blockchain, now there's an important idea. And the reason is, as I told you earlier, many things have ownership transferred by ledger entries. And, for example, securities transfers of stock from one person to another. And so what the banks have done is, and they're full speed ahead on this, is they're taking blockchain, not the Bitcoin part, but the blockchain concept, which is a distributed registry that's unhackable. And they're doing it privately. So Mellon Bank N.A., my bank in Pittsburgh, which is the largest custodial bank in the world, it holds 25 trillion US in assets for people. Holds or controls 25 trillion. It's the largest in the world. They hired some folks at CMU to create a private blockchain for the bank. It's not public, but the registry is going to be distributed around the bank's offices. It's going to be totally private, but it's secure against hacking because it uses the same nonce concepts. So if a hacker breaks into one branch of the bank and tries to modify the transaction records, can't do it. And even if he did, it wouldn't agree with the records at all the other branches of the bank. So blockchain is a very important artifact. Ownership records, land, vehicles, art, very expensive art, documents of title, securities, all of those things, ownership can be transferred over a blockchain. It can also be used for voting. You certainly, when have people vote in a democratic election, you don't want somebody to be able to alter the voting records to change the outcome of the election. Healthcare, electronic medical records, you don't want people modifying your medical record. For example, you don't want a hacker doing that. They could change your prescription to a different drug, and you get something in the mail, and you die because you don't get your regular medicine. All of these things are uses of blockchain as opposed to Bitcoin itself. So there's an old saying in the software engineering world, build one to throw away. When you design a new system that you've never implemented before, you go through a lot of work implementing it, you test it, you put it out there, you see what's wrong with it, and then you throw it away. You discard it, and you build a totally new system that doesn't have the defects of the first one. Bitcoin didn't do that. There wasn't one to throw away. Bitcoin is the original. And it has issues. It has problems. And now it's the subject of dispute among the members of the network as to what changes should be made to the Bitcoin code. And so eventually what's going to happen is Bitcoin will come under the control of the network, not a government, but all the guys in the network, or majority, are going to have to agree to change the code, and they might at any time. And so Bitcoin had some great ideas, including blockchain, but Bitcoin itself is not necessarily forever. All right, I want to take questions so we can finish up for tonight.
Can we, because the whole Bitcoin is based on the network,
Yeah.
the communication. So in a way, can we, instead of hacking the blockchain, can
Yeah.
we hack the network?
Okay.
So,
I just want to make sure they heard your question. He says that you can't hack the blockchain because of the hash protection. He says, why don't you just hack the network?
then
Okay, how do you hack the network, though? You gotta hack the whole internet.
Yeah, no, but instead of like hacking the entire internet,
Yeah.
right? For example, in US, we can hack the submarine cable in a sense.
Yeah.
It's fewer place to attack, right? Then in a case, then we just only focus on the not inside the New York.
Yeah. But in order to do that, if you hack the submarine cable, you have to know what the destination address is of all the nodes in the network. And they can change their destination address at any time. And furthermore, when you do that, what are you doing? Are you preventing them from getting the transaction record? Or are you trying to alter the transaction record?
Trying to alter the transaction record with only limited nodes, but then because I had the network congestion, so then they cannot actually have the broadcast to all the network.
Yeah.
Then in a sense that I don't really need to have
Right, so then-
1% of the...
Right, so how long will the network live without recognizing that that's happening?
I don't know, just having
Yeah, I don't know, 10 minutes or something. They'll know very fast that something's wrong, and they won't verify the transactions. So by the way, the submarine cable, I mean, you got to hack a lot of submarine cables because there isn't one that goes from the United States out, right? There are many, and they're not all submarine cables. So I don't see there's an effective way to do that. But hey, if you try it, make sure you do it in a country that doesn't have an extradition treaty, though.
I'm just thinking from an NSA perspective, because like for Tor network, right, they said the NSA can actually hack it because it control majority of the Tor router.
Yeah.
So I'm just thinking for the similar case that can we replicate the similar
Yeah,
attack
but
in US?
you have to know which routers go to these various 11,000 nodes in the network.
But in case I just shut down the US, then it's on its own.
Well, we're going to know right away if you shut down the U.S.
Okay, but so they have to keep a live connection with other miner.
Well, they don't keep a session-oriented connection. What they do is when it's time to broadcast the transaction, they'll open a TCP/IP connection.
Oh, okay.
Yeah, it's not.
So then they know that a lot of people disappear, then it's not really a secure network.
Well, they'll know because one node regularly transmits to like 5 other nodes. If he can't open those TCP/IP connections, then he knows something's wrong.
Okay.
Yeah.
So they do have a lot of like.
Oh, well, you saw with blockchain.info, a lot of folks are watching this all the time, including the U.S. government and Russia and China. They're all watching it too. Anything else? So on the assignment is made up. You will see the assignment during the break on Sunday, and we will go through it, and I will tell you my expectations for the assignment. Anyway, good night for tonight.